Hello everyone. In this video, I will be talking about the market efficiency and behavioral finance. This topic corresponds to chapter 7 in the Jordan book. But in these slides, I cover slightly more information than the Jordan book. So the exam will be limited to this slides. So what is the big question that we're asking in this chapter? In the previous chapter, we've learned several models that tells us how much stock should be worth, right? So there we're trying to figure out the fair value or the fundamental value of a stock, right? But on the other hand, the market price that we see every day, it might necessarily equal to the fair price, right? So sometimes they're the same, sometimes not. Okay, the question here is what determines the stock price on the market. Okay, so in general, the prices go up when there's good news. When there's bad news, the price goes down. Okay, but the price could also be so in here we're essentially saying that the price are affected by information, but on the other hand, the price could also be affected by investors' behavior, their sentiment, or their speculation behavior. Okay, so those are two general views about the stock price performance. Okay, so the first type of view we call it efficient market hypothesis. We call it hypothesis because it's just a hypothesis. The market does not necessarily behave that way. Okay, so anyway, what it says is that the price accurately reflect information. So investors as a group are rational so that they can efficiently and correctly process information. So essentially what it says is that the price move only because of information, right? So good news, good information, price go up, bad information, price go down. In other words, the price, according to this hypothesis, the price we see on the market, it does truly reflect the true value of the stock, okay, nothing else. Okay, another type of view, we call it behavioral view. Okay, so what this says is that the stock price might not necessarily only reflect information, because investors, as any human being, sometimes we're not fully rational, so we're subject to our behavioral bias, and those bias could potentially affect the prices in an irrational way, right? So whether which type of view is correct, and what does each view mean? That's what we're going to talk about in the following slides. Okay. When we ask the question whether a market is efficient, there are several questions we need to know, right? One, does the stock market incorporate information? And how fast does it incorporate information? How accurately does it incorporate information? So of course, if a market does reflect information and it does so very fast and accurately, then we would say that the market is quite efficient. Now, what it takes for a market to be efficient. So here are the necessary conditions. First, if the market wants to be efficient and incorporate information. So first, there has to be a lot of knowledgeable investors that understands those information and they're actively analyzing and trading those stocks. And the information has to be widely available to investors so that they can notice it and analyze it. And the events would happen randomly. And lastly, the investors will react very quickly and accurately to those information. Okay. What are the implications of an efficient market hypothesis? In other words, if a market is quite efficient, what are the implications for investors? Okay. So first, obviously, all the available information would be fully incorporated into the prices of the securities. Okay, this is quite intuitive. And two, the return that investors earn on their investments cannot be predicted. Okay, the reason being that all the available information is already incorporated into the prices. Now, what's going to affect the future prices? It's going to be the future information. Okay, but the future information happens quite randomly, as we've said in the previous slides. Then it happens randomly, and nobody is able to predict the future events. Therefore, investors cannot predict the return that they can have, or they cannot predict the trend of the future prices. Okay, and the future stock return will follow a random walk, meaning it happens quite randomly, so nobody really can predict it. Okay, so we'll explain the second point in more detail in the next two slides. But before we do that, I want to introduce a very important concept, which is called excess return or abnormal return. Okay, in the previous chapters, we've learned that suppose as an investor, you know that there's a stock that will give you a cash flow of $106 in the future. And you want now you want to purchase it. You think it's quite risky, so you demand a 6% required rate of return, so you're gonna pay $100 today. Okay, in other words, if you earn 6% return, this return is just enough to compensate for the risk, so this is called risk adjusted return. Okay, now suppose somehow in the market, the price is only $90. Okay, so for the investor who thinks it's gonna be 100, then it's quite a bargain, right? If you can purchase at $90, the return you can get is actually 17.78%. Okay. Now, this 17.78% can be decomposed into two parts: the 6%, which is the risk-adjusted return, and another 11.78%. This we call it alpha, or we call it excess return or abnormal return. Okay, so in the market, if you get 6%, that means you just you're as good as the market. But if you can get some alpha, that means you beat the market. Okay, so there is a website that's quite famous called Seeking Alpha. That alpha is this abnormal return we're talking about. Okay, so as an investor, you always want to get this alpha. Okay, the more you get, the smarter you are. Okay, but sometimes it might be by luck, and sometimes it's because you're quite smart. Okay, so bear in mind those two concepts: alpha and risk-adjusted return. Okay, so now when we say that in the following slides, when we say that if a market is efficient, nobody can earn excess return, that's what we mean. Okay. We say that efficient market is one where information is fully incorporated into the prices, right? Now, in the market, there are a lot of information. Depending on the availability of those information, we can actually classify them into three types of information. One is the past stock information. So including the stock prices, the trading volumes, or any past information related to a stock. So this is very easily available. A second layer is the public information. So those are the information that's released right now, right? So including the, let's say, firms' earnings announcements, okay, when let's say the firm's CEO resigned, or all those kind of current information. Okay, so that's harder to get compared to the past information. And the last layer, which is the hardest to get, is the private information. So those are the information that is only available to a small group of investors. Right. So, for example, the CEO of a firm, they would know more than anybody else about his firm, right? So the information that he has but nobody else has is called private information. Okay. So there are two sources of the private information. One is probably because this body, he's an insider, so he has more information than anybody else. The second source could probably be that you're an investor, you put a lot of effort in analyzing the current information. So you know more. So you know more than everybody else, but it's because you work hard and based on the information that everybody has. Okay. Um, so now, if the more information the market the stock price incorporates, the more efficient it is, right? So that's why we can, based on that, we can classify the efficiency into 3 levels. If the stock price incorporates the past security information, we call the market weak form efficient. If the market also incorporate all the current public information, then we call it a semi-strong form efficient market. If the market also incorporates the information that only if it also incorporates the private information, meaning that it incorporates all the information, then we say that the market is strong form efficient. Okay. So what are the implications of the different levels of efficiency? Let me use a very simple example to show you what are the implications. Okay, so suppose we're looking at a stock and we're valuing the stock using the discount dividend model. Okay, let's say according to the past information, we forecast that the next period the stock's dividend will be $1. Okay, so 1 divided by R minus G, so assuming the required rate of return is 20% and minus the growth rate, which is 10%. So we think that the price should be $10 according to our past information. Now, let's say the firm also released a current quarterly earnings report. According to that report, the information should be updated. So next quarter, the dividend actually will be $2. Okay, now according to the current information, then the price right now should be $20. Okay, let's say there's another insider. He knows more than anybody else. He knows that the next period the dividend should actually be $3. So his valuation will be $30. Okay. So now what are the implications? So if the market is weak form efficient, then that means the price now will be $10. Okay, so what's the implication? Implication is that if the price now is already $10, then if you want to use any past you want to analyze any past information and try to predict the future, you cannot do that because you know it's 10, it should be 10, but it's already there, so you don't know where it's gonna go in the future. On the other hand, the information that's not incorporated will help you in predicting the future, right? So based on the public information, you know the actual price would be $20, so you know exactly that the price will go up in the future. So if the market is weak form and you have public information, then you can generate an excess return because you will buy it now for sure. So you're gonna get you can beat the market. Another implication for the weak form efficient market hypothesis is that if you do technical analysis of the past stock price, it's not going to help you generate excess return because the technical analysis is where where you look at the patterns of the past stock prices and trading volumes and so on, and hope to get some insights into the future. Okay, so if the market is already weak form efficient, all those information is already in this $10, so you're not gonna be able to predict anything. Now, if the market is semi-strong, what's gonna be the price now? The price will be $20. Okay, so if it's 20, what does that mean? That means if you want to use the current public information to predict the future, you're not going to be able to do that because it's already 20. So you don't know where the future is going to go. That will depend on the future information, right? On the other hand, the insiders, he will be able to predict the future price movement because this information is not incorporated yet. So he knows perfectly that the price in the future will go to $30. So he can actually generate an excess return. Okay. Now, the third layer, if the market is strong form efficient, then the price now will be $30. What does that mean? That means nobody can generate excess return if the market is indeed strong form efficient. Because even for those insiders, he knows it's going to be 30 and the price is 30. So he cannot purchase the stock at a lower price. Okay, if he can't do that, then he can't generate excess return where he doesn't know where the future is gonna go. Okay. So the question is, where is our market? Is our market weak form, efficient, semi-strong, or strong? Okay. I think a general understanding is that the U.S. market right now is quite semi-strong efficient. So it is very efficient in generating, in incorporating the current public information. But it's still not strong form yet because there are a lot of insiders who are still profiting every day. Okay. So here's an evidence that supports the semi-strong efficient. So this is on the x-axis. Those are the days relative to the earnings announcement date, and this is the return for the stock. Okay, so what we can see from this table is that whenever firms announce their earnings on day 0, if it's a good news, the price goes up immediately, right? After that, the return are quite close to 0, so the price doesn't change much. So we can see that the prices are very sensitive to the positive news announcements. Okay, so that means the market is quite efficient in incorporating any public information very quickly and quite accurately. Okay. All right, so here's a question related to the efficient market hypothesis. So the strong form of the efficient market hypothesis contains that one, investors will be able to consistently generate abnormal profits by analyzing the past stock information. B, no one can consistently earn abnormal profits. C, a selected few institutional investors can earn abnormal profits. And D, no one can consistently earn a profit. The correct answer will be D, right? Because if the market is already strong form, it incorporates as much information as possible. So even the insiders, their information is in the price, so they can't profit from that. Okay. So just a few technical terms. The institutional investors mean those institutions such as the mutual fund, hedge fund, pension fund, insurance companies, and so on. In contrast to the institutional investors, individuals are called retail investors. Okay. So we generally think that the institutional investors are more sophisticated and they understand better about the market. Okay. Besides some evidence that suggests the market is somewhat efficient, there's a lot of debate on whether indeed this market is quite efficient. So people have discovered a lot of phenomena that is inconsistent with this efficient market hypothesis. Okay, so we now look at some of them. One of the phenomena that people have discovered is the calendar effect, which suggests that stock returns may be closely tied to the time of year or the time of the week. Okay, so for example, we have the January effect, which says the stock return is generally higher on January, and also some weekend effect. Um, so if the market, so why is this inconsistent with the efficient market hypothesis? Because if the market is efficient, then people have, then any patterns that appeared in the past, people should realize that, and they should take advantage of that so that this effect will go away, right? For example, if we all know that in January the stock return will be higher, we know that from the past experience, then we should all purchase the stock in December, hoping that the stock return will be higher in January. Now, if a lot of people purchase it in December, then the price in December will already be very high. So the return in January would be lower, right? So in that way, the effect should go away. But the fact is that the January effect is still there, kind of suggests that the market is not very efficient in incorporating the past information. Okay, and we have the small firm effect. According to the historical data, we kind of see that the smaller firms offer a higher return than large firm, despite the risk. Okay, so it says that if you look at two firms, they're of similar risk level according to our measure, but oftentimes the smaller firm will give you a higher return. Okay, so this is again inconsistent with the efficient market hypothesis, because if this is if we all realize that information from the past experience, then we should take advantage of that. In other words, investors will all buy more of the small firms because it gives them a higher return. Then the if a lot of people buy those firms, then the price will be higher, return should be lower. Okay, so eventually the return from the small firms and big firms should be the same. Okay, controlling for the risk. Okay, again, the effect is still there. Seems like people are not taking advantage of their past experience. We also have the post-earnings announcement drift, which is illustrated in this graph. Okay, so what people have seen in reality is that when a firm announces a good news, okay, so maybe their earnings or their net income is higher than what people expected, so that's considered a good news. So when a firm announces a good news on day 0, the price does go up. Okay, so suggesting the price is sensitive to the news. But what we see oftentimes is that after day 0, the price continues to go up. Okay, so this says that maybe on day 0, people does not fully adjust to the good news. Okay, so it takes a long time for them to incorporate this good news. So it's again kind of contradictory to a very efficient market. Remember in the previous slides, we say that the efficient market does not only incorporate information, but it has to do this quickly and accurately. Okay, so here it doesn't seem to be very quickly. On the other hand, when a firm announces bad news, what we see is that on the day of the announcement, the price does go down. So the return is negative, but it's not negative enough, right? So it continues to go negative in the following maybe 52 weeks. That's a year. Okay. So again, it says that it does incorporate information to some extent, but not fully, okay, and not quickly enough. What could be the possible explanations for the anomalies that we just saw? So there are several of them. The supporters of the efficient market hypothesis says that, well, those evidence doesn't actually prove that the market is inefficient. Rather, it's because those evidence are interpreted incorrectly. For example, the size anomaly says that the small firms offers oftentimes gives investors a higher return compared to the large firms, even when their risk level is the same. This supporter says, well, it's probably because you are measuring the risk incorrectly. If you measure it correctly, maybe the size small firms are indeed riskier than large firms. That's why they offer a higher return. So it's not any anomalies that's not supported by theories. Some others say that those anomalies may just be some one-time pattern that appears by chance and not necessarily persist over time. So it doesn't reject the efficient market hypothesis either. Another very different explanation says that so maybe those anomalies are indeed anomalies, but they are probably caused by investors' behavioral bias. Because as human, those investors suffer from some systematic mistakes when they invest, and those mistakes can create inefficiencies in the market. Okay, so in the next few slides, we're going to talk about some of the behavioral biases that researchers have documented. So the first type of behavioral bias is called overconfidence. So what does that mean? A very simple example would explain it. So when researchers ask a lot of subjects, do they consider themselves to be above average driver? Actually, almost all the people says that they think they are. And it cannot be true, right? Only half of the subjects could be above average. So this says that some people are actually, a lot of people are overconfident. So overconfidence means that investors will be confident in their judgment, so that will lead them to underestimate the risk and overestimate the accuracy of their information set. So researchers have found that investors whose portfolio had outperformed the market, meaning they earned alphas, in the past, they would subsequently increase their trading activity. So that means they now they become too confident and they think they know a lot, so they trade a lot. And what's the consequence? They actually subsequently underperform the market by about 3% per year. So that means in the following several years, and this overconfidence actually lead and the underperformance of their portfolio. So overconfidence could could cause investors to trade too much and have a very biased view of themselves. And self-attrition bias is the finding that investors tend to take credit for success and blame others for failures. So I think like humans often suffer from such bias. For example, when we don't do well in an exam, we think it's the professor's fault maybe, but when we do very well, we think it's because we work very hard and we're very smart, right? So investors are the same. So if they suffer from such bias, they oftentimes will follow information that supports their belief and disregard the conflicting information. So as a result, sometimes they would be very slow or reluctant in updating their beliefs when new information came out, right? For example, if they just like like a certain firm very much, they think and they know a lot about the firm. So when a bad news about the firm came out, they might be very reluctant in updating their belief. So they wouldn't sell the stocks when they actually should, right? So those bias could lead to some other irrational behavior as well. The next type of behavioral bias is called loss aversion. So it says that investors dislike losses much more than they like gains. Okay, it's the same as any a human, right? So a loss could cause us so much pain, but the same amount of the gain does not cause us the same amount of satisfaction. Okay, so a result of that in the stock market is that researchers have found investors oftentimes they would hold on to the stocks that's losing money, okay, because they don't want to realize the losses. So if a stock the price goes down, let's say by 10%, if you don't sell it, you are actually not realizing the loss, right? So what people often do is that they're gonna hold on to those losing stocks and hope that they will bounce back later, so they don't lose money anymore. Okay, but on the other hand, if a stock is making money for them, let's say a stock price increased by 5%, there's a very big chance that investors are gonna sell those kind of stocks, even though that maybe the price will further go up. This is because the further increase in the stock price does not give them so much satisfaction. Okay, so they oftentimes sell it early, and this type of behavior is actually called a disposition effect in finance. Okay, so this example will show you exactly what the loss aversion means. Okay, so let's give you two scenarios, okay, to make choices. In scenario one, suppose you just won $8,500 in a game. You can walk away with your winnings, or you can risk them. If you take the risk, there's a 90% chance that you're gonna win an additional 1,500, but there's a 10% chance that you're gonna lose everything. Okay, so what would you choose? Researchers have found that most of the people would choose not to take the risk. Okay, so they're gonna walk away. In scenario two, it's slightly different. Suppose you just lost $8,500 in a game. Again, you can walk away, or you can gamble. If you gamble, there's a 90% chance that you're gonna lose additional $1,500, but there's a 10% chance that you're gonna win $8,500. In this case, researchers have found that most people actually will choose to take the gamble. Okay, so what does this two scenarios tell us? In scenario one, the expected return for taking the gamble is actually $500. So that's 90% times 1,500 plus 10% times the 8,500. So a lot of the people actually choose $0 over this $500 expected return. Okay, so that means when you're in the winning scheme, the additional return doesn't give you that much satisfaction, so you're not willing to take the risk for the additional return. Okay, but on the other hand, in the scenario two, the expected return is actually negative $500, but most people actually choose to take the gamble over $0. Okay, so this is because when they're in the when they're having a loss, this loss caused them so much pain, so that they really want to cut the loss or reverse their initial loss. So that's why they're willing to take the risk. Okay. So again, an outcome for this kind of behavioral bias is we tend to hold on to the losers for too long, even though sometimes maybe there's a very bad signal from the firm that really suggests that we should sell the stock. Okay, because there's a reason for the price drop, right? But because we suffer from this loss aversion, we might still hold on to the stock because we don't want to realize the loss. Okay. And when there's very good news, when you're making money, you tend to sell it too early, even though maybe sometimes there's a good reason for the price increase. Maybe the price will further go up, but those additional profit doesn't cause you much satisfaction. Okay, so those are again some irrational behavior. Representativeness says that investors have difficulty assessing whether some events are random or not. Okay, so their general rule of thumb is that if an event happens consecutively, Most likely such event is not random, so it's going to repeat it in itself in the future. And if an event only happens once, oftentimes they think that such event is quite random and it's not going to be repeated in the future. Okay, in reality, those beliefs probably are wrong. Okay, um, so an example of this overreaction to a series of similar events is that researchers have found that the mutual fund managers who have performed well in the past several years, they often witness a huge money flows into their the mutual fund that they manage. Okay, so that means a lot of investors see that they perform very well, and they believe that such mutual fund managers are actually very smart, and they are likely to continue to outperform in the future. That's why they put their money with those mutual fund managers. Okay. However, in reality, a lot of the research have shown that those mutual fund managers, their performance oftentimes are not very consistent. Okay, so meaning their outperformance oftentimes are driven just by luck. Okay, so investors have incorrect belief of the probability that such events are non-random. Okay, so a result of that is that we've seen that those investors who put their money with those star managers, they actually don't see a very good performance in the following several years. Okay. On the other hand, the investors tend to underreact to a single piece of information that happens once. Okay. So an example would be that suppose there's a firm that continues to that has been losing money for a few years, and all of a sudden this year, maybe because their manager just works harder and harder, and they turned profit. Okay, so to the investors, it should be a very good news, right? Because they've been losing money, and all of a sudden they start to turn profit, and they are likely to do that in the future as well. But to the investors, because this piece of information only happens once, they tend to think that it's just random or it's just pure luck. So they would underreact to such good information. Okay, that will lead to the incorrect pricing of the stocks. Okay. On the other hand, if there's all of a sudden a firm that has been performing very well turned realized some very big loss, that's actually a very bad news, right? If it's going to happen in the future as well. But oftentimes investors think that it's just very random, and they would not think it's such a good bad information. Okay, so they would again underreact. Now, narrow framing says that investors oftentimes they analyze a situation in isolation and ignores the larger context. Okay, so for example, we as humans, we tend to buy cars without considering whether it fits the garage. Okay, and a merchant can mark a product as priced at 100 but on sale for $60, and investors will be very happy with that. Okay, and they don't realize that the actual value of this piece of cloth is actually just maybe $60. So they consider a situation without the larger context. So a net result of that in the stock market is that an investor could get very excited about shares of a particular, let's say, stock, and purchase the stock without realizing that his portfolio is already overweight in tech stocks. Okay, so an investor could be under diversified. Okay, if he suffers from the narrow framing. Belief perseverance says that investors tend to ignore information that conflicts with their existing belief. Okay, so this is kind of related to the self-attrition bias. And familiarity bias says that investors tend to buy stocks that are familiar to them without thinking about whether the stocks are good buys or not. Okay, so those biases could both lead us to make some irrational decisions. What are the phenomena that people use the behavioral biases to explain? So one example is the stock return predictability. So one thing we found in the stock market is that there's a momentum effect. So the stocks that perform well in the past tend to continue to perform well in the future, and the ones that performed poorly continues to perform poorly in the future. Okay, so one explanation of this could be that initially investors underreacted to certain information, maybe because their representativeness bias or other types of bias. Okay, um, and the value stocks may outperform the growth stock. So the value stock are the stocks with a relatively low PE ratio. Those are the stocks such as Walmart, and they're kind of stable and have a low PE ratio. And the growth stock are the stocks that are have a high PE ratio, maybe the Amazon or Google, and those type of stock that people think will grow very fast in the future. So the value stocks will give you a higher return than growth stock, potentially because people are overly enthusiastic about those growth stock. That's why the prices are higher and the returns are lower. How does those behavioral biases affect investors' behavior? There are several findings. One is that investors who believe they have superior information, or the investors who suffer from overconfidence bias, they tend to trade too much and earn lower return. And investors tend to sell stocks that have gone up and keep the stocks that have whose price has declined. So that was the disposition effect that we've talked about. And sometimes they act on emotion instead of rational analysis. Okay, and those could reduce the market efficiency. So researchers have found that not only investors suffer from behavioral bias, but also the stock analysts suffer from some biases as well. Okay, so the stock analysts are the people who spend a lot of time on a certain stock or a certain group of stocks, and they make recommendations to investors, and they forecast the future performance of a firm to provide information to investors. Okay, so they are supposed to be the professionals or the sophisticated people. So one of the bias that that has been documented is called herding. So the analysts tend to make similar recommendations as other analysts. Okay, so maybe because they think it's safer to release similar opinions as others, or maybe they think the others have good reasons for doing that, and they believe others are correct. Okay, so an analyst could be overly optimistic about a favorite stock's future, so that leads to a biased view of a certain stock. Okay, so those are some examples. So based on those behavioral biases, what are the recommendations for a retail investor? So first, don't hesitate to sell a losing stock. Okay, because oftentimes there might be a very good. So be rational, right? Think about is there a good reason for the stock price decrease? Okay, if there is one, don't be affected by your loss aversion. Just sell those, okay? And don't chase performance. Sometimes you see a mutual fund manager that has been performed very well. Be rational and think about is that pure luck? Okay, if it is, then just don't follow those performance. And you need to be humble and be open-minded. Okay, don't be affected by your own overconfidence. So listen to the information and listen to some objective analysis. Okay, and review the performance of your investments on a periodic basis, and don't trade too much. Okay, if you trade too much, not only you could be wrong, but also those transaction costs will cost you a lot. Okay, so don't forget to do the quiz on the Connect system. See you in class.